Hello, ladies and gentlemen. This is your teacher Usman Ali, and we are here to discuss or solve the numerical 1 of chapter number 4. It is related to the cross interest arbitrage concept. In this numerical, we are given the interest rates of two currencies, actually US dollar and Mexican peso. The lending and the borrowing rates are there. So the US dollar, if you had a deposit with the bank, okay, in US dollars, so you will receive 8% profit on that. But if you take loan in dollars, then it's gonna cost you 8.3%. Likewise, Mexican peso, the lending rate is 8.5% and the borrowing rate is 8.7%. Okay, so along with this, the Blue Demon Bank expect that the Mexican peso will depreciate against the US dollars. Now, we are doing this numerical from the Jeff Madura book, and the author by default has taken US dollar as the base currency actually. So US dollar will be actually taken as our base currency or local currency, and Mexican peso in the question will be taken as our foreign currency. So it says that the Blue Demon Bank expect that the Mexican peso will depreciate against the dollars from its spot rate. Okay, so Mexican peso is a foreign currency and it is depreciating. So if we look into that borrowing and lending rule, by the way, by this time you must have watched a video by the name of borrowing and lending rules. Okay, so Mexican peso is a foreign currency and it is depreciating actually against our local currency. So we're gonna apply borrowing rule, which means we will borrow money in Mexican peso. Okay, so that's the starting point. So assume that if we borrow money, so we have an opportunity to borrow $10 million in USD, or if we borrow money in peso, then we can borrow 70 million pesos actually. Let's solve part A. The video only focuses on part A. We will have next video for part number B actually, because the numerical is kind of little long. So how would Blue Demon Bank attempt to capitalize on its expectations without using deposited funds? So we need to estimate the profit actually. We need to find the arbitrage flow here. Okay, so let's do the numerical then. Okay, but just before starting the numerical, I forgot this part. Let's discuss this one as well. So Mexican peso will depreciate against the dollar from its spot rate of $0.15 to $0.14 actually. So currently the spot rate is 1 Mexican peso is equal to $0.15, but we expect that in coming 10 days the Mexican peso will come down to $0.14, which means Mexican peso is depreciating and dollar is appreciating. So Mexican peso is our foreign currency, and due to its depreciation, what we're gonna do actually is we're gonna borrow money in this currency. Okay, so let's start the numerical. We are doing numerical 1. And this is the part A of actually this numerical. So in step number 1, we are supposed to take loan. So we will borrow money in Mexican peso. Okay, and how much money we have to borrow? If you remember the numerical, we had a capacity of borrowing 70 million Mexican pesos. Now we are actually Americans here, and we don't need Mexican peso actually. We need to convert back it to our base currency so that we can invest and make money out of it. Okay, so in step number 2, we will convert this 70 million Mexican peso into US dollars. Okay, I can give it just a step name, conversion. So let's do the conversion here. 1 Mexican peso is equal to $0.15. Okay, in other terms, this can be written as dollar divided by Mexican peso equal to 0.15. I just did it for you people, that you can recall the rule of currency in hand rule, that the currency in hand, we have 70 million in hand, must be written at the bottom, so everything is fine. So if 1 Mexican peso is equal to $0.15, then the 70 million Mexican peso would be equal to the quantity 70 million multiplied by the rate 0.15. Okay, so when you do the conversion of this, when you multiply that, you get $10.5 million. Okay, now in step number 3, whatever dollars we got, we will deposit this dollar actually. We're going to deposit this money in the bank account. Okay, let's say with the terms of that the interest rate percentage will be, if you see here, if we're gonna lend the money to the US bank, we are expected to receive, or we are entitled to receive 8% profit. So I will write here the interest rate will be 8% or 0.08 indirect actually. Okay, so you can write 8% or like this. Okay, then the number of days is 10 days, and the money that we are depositing, which is our present value, would be 10 million and 5 or 10.5 million, you can say, in dollars. Once we have deposited this, then we won't do anything else other than wait for 10 days to get over. Okay, we will wait for 10 days. Once those 10 days are done, then we move to our fifth step, where we will reclaim, or we will receive back our dollars which we actually deposited. Now how much money we will receive back? Future value is equal to present value, 1 plus interest power n. Now the interest rate is 8% and that's annual. We are only depositing money for 10 days. So I will just divide this interest rate by 360 here, making the rounded number of years in days in 1 year. We deposited $10.5 million actually into a US bank, and the interest rate we have is 0.08, got 360 days, rounded days, and we deposited that for 10. So I will divide 0.08 by 360, then I will plus 1 with the answer, and then I will take the power 10 of it. So in short, the end result of the whole process that I've just explained will be 1.0022224458, and the total money that we will receive would be 10,523,356.68, and this is a rounded figure that we will receive. Okay, remember this. Now this is the amount of money that we receive. What I will do is that obviously I had to return back the loan which I took from the Mexican bank. Now I don't need to convert all of these dollars to Mexican peso and finish the liability. I will only convert that much dollars which is needed to finish the liability in Mexican peso. Okay, now in order to know how much money is actually needed to finish the liability, I will go to my step number 6. And in step number 6, my objective would be how much is our payback in Mexican peso. How much money that we had to give back actually to the Mexican bank. In order to calculate that, again I will go to the future value, which is present value, 1 plus interest, again divide by 360. You know the reason now. So we actually took a loan of 70 million Mexican pesos, and the interest rate, if we deposit money in Mexican bank, if we borrow money from Mexican bank, is 8.7%. That's the borrowing rate. So this is 0.087 divided by 360, and the whole period is 10 days actually. So I will divide 0.087 by 360, will plus it with 1, and then we'll take the power 10. So you know the basic mathematics. I will save time and MBs for you. 70 million. The end result of this would be 1.0024192965. Okay, and if I multiply that, this will be 70 million 1,69,350.75 Mexican peso is the amount of money that I must return. Okay, now my next step actually would be that, okay, I got that how much I had to pay back to the bank. The question is how many dollars must be converted to purchase this much money. So I will only convert those dollars. Okay, so how many dollars are needed to be converted to Mexican peso. Now 1 Mexican peso, it's after 10 days now. So what we will do, we will apply the forward rate actually here. So the forward rate after 10 days was $0.14 equal to 1 Mexican peso. So 1 Mexican peso is equal to $0.14. Okay, how much Mexican peso do we need? We need 70,169,350.75 Mexican peso we need. So this would be quantity into the rate, which is 0.14 by this time after 10 days. Once you multiply this, so you will get an amount of dollars. Okay, so let's multiply it. When you multiply this, you get around 9,823,709.11 rounded figure. So ladies and gentlemen, actually we receive, when we invested money in dollars, we received 10,523,000 from the bank bag. Out of this money, we only need to take this much money and convert it to Mexican peso. We get this quantity and then we can finish the liability. The remaining money that we don't convert is actually our profit. Okay, let's calculate that, how much we would end up with extra. So to calculate that, we had cash inflow minus the cash outflow. Our cash inflow was 10,523,356. Okay, rounded figure. This I took it from step number 5. Okay, and then step number 7, 9,823,709, the rounded figure. When you subtract it, you will get $6,99,646 as your gain. You can call that gain due to currency, capital gain. Okay, so actually we had a numerical where our foreign currency was depreciating against our local currency. So we applied the rule of borrowing. We borrowed money in the foreign currency actually. In our example, it was Mexican peso. We borrowed that and we converted it to our base currency. We invested that. We got back our money from our local bank. And then we only converted that much money which is needed to finish the liability. So this is the money we have, and this is the money going out to finish the liability. The remaining is my profit by following this whole process. So ladies and gentlemen, this was the numerical 1 part A. Next video would be for the part B. Okay, and this was actually that how can you make profit using borrowing if the foreign currency is depreciating. The whole concept or the topic of the numerical is actually called as covered interest or arbitrage. Thank you very much, ladies and gentlemen. Stay safe.